Good day, learners. In this lesson today, I'm going to look at the cash budget. Now, the important thing to note here, we're talking about cash. So it's only money coming in and money going out. The budget implies that we're looking to the future. So the whole point of drawing up a budget is part of our planning, so that we can see that have we got enough liquid cash in the future. In other words, is there enough cash around or things that will convert into cash in order to pay all your expenses and to pay all your accounts. Now, the first thing that you need to focus on when you're looking at the budget is the sales. So you will be given or you'll be calculating. In other words, they could say to you it increased by 10% on the last year's or something. But the first thing you need to identify is what your sales are for the months that you're working. So I've given you January sales are 100,000 and then February's 150. So that's the first thing you need to identify. Then with sales, we can have cash sales or we can have credit sales. Now this has a bearing on the budget because cash sales get collected in the same month in which you make the sale. In other words, straight away. If I go into the shop now and pay cash, they've got the money straight away. Whereas a credit sale is when you sell to your debtors, that money will only come in later. And if you are planning as to how much cash you've got, you can't go depending on money that hasn't come in yet. So you've got to work out when do you expect that cash to come in. So you will be given, and in this example, 20% is for cash and 80% is on credit. Now that's given to you. So January, 20% is for cash and 80,000 is for credit. All right, there's the cash sales, there's the credit sales. And I'm looking at January, dividing it into 20% and 80%. February was 150,000. 20% of that will come in as cash and 120,000 will be on credit. And so the first thing I can do is take those cash sales figure and put them into your budget. Now, when you're doing a budget, as always, please be very careful what dates you're working with. So you're budgeting for January and February. So that is the 20% cash sales from January and the 20% February. Fairly easy, just going in the same month. The problem comes with the credit sales. And it is customary in most businesses to actually have a trend as to when these debtors will pay. While it's pretty well the norm that debtors are expected to pay in 30 days, reality doesn't always allow that. And if you're budgeting, it would be wrong if you had to budget everything to come in 30 days. So your budget needs to be realistic. Your terms might be one thing, but when do you expect to get it? And these percentages will come up by them analyzing past trends. So we've got 40% in the month of sale, 45% in the month following the sale, and 10% in the second month. Now this is very important. You need to look at the first one. Is it in the same month or is it 1 month later? So if, for example, I'm looking at November, if it's in the month of sale, it's the same month. Looking here. If you sell goods in November, here's the timeline for November, you would be expecting to get 40% in that month. Then 45% would come in December, 1 month later. Just go on your calendar. November, go 1 month forward. It's December. And January would be 2 months forward. Another concept we need to just make sure that you will understand is this concept of 30 days and 60 days. 30 days actually means the month thereafter. It doesn't mean that you sold the goods on the 3rd of November, so you expect to receive them by the 3rd of December, because that is 30 days later. That's not how it works. The business will sell goods throughout November, They will send a statement towards the end of November, and the person then generally has got 30 days to pay. So in effect, people can buy throughout November and then take until the end of December to pay. So if you were asked the question, what percentage of your debtors are sticking to their credit terms, it's going to be both of those. Because you're giving them 30 days, so they actually can take up to the month afterwards. This is a bonus to you. So that's just something on the side which you often ask when you look at the debtors and you have to analyze it. So if we take this now, although we are working for January and February, because the debtors are taking 2 months later to pay, that means that people will be paying in February for goods that they bought 2 months ago. So in February, 2 months ago would be December. In January, we will still be collecting money from 2 months ago. So going back here will be November. So hence, we now do what we call a debtors collection schedule. And this is where we calculate how much money we're going to get in each month that we're budgeting for January and February. And that money will be coming in from November, December, January, February. So just remember, the reason why I've gone back to November is because some of your debtors are taking 2 months to pay. So transfer your credit sales from earlier, the 80 and the 120. And in this case, I've actually given you the credit sales for November and December. If you're not given them, again, you'd have to go back, identify your sales, and get your credit sales. Right, now it's these figures we're dealing with now, because these are our debtors. Our debtors are paying the credit sales. So I'm going to start now in January. So in January, I sell goods. It tells me that 40% of them will pay in the month of January. Now it's 40% of the amount. So it's going to be your 80,000 times 40%. Now that 40% gives you a figure of 32,000. So 32,000 Rand is expected to come in the same month. Now only these people get the discount. Not all the debtors, it's the people paying in the same month. And the discount is 95%. So you can calculate what is 95% of 32,000, because we're only going to receive 95%. Or you could have done it a longer way, 32,000 times 5%, and then do a subtraction. And so that means that up here, I'm expecting to get 30,400. All right, so just watch that. You're working on the 80,000. It's 40% in the same month, so it's January, we'll be collecting in the same month. 40% I work out first, and then I work out 95%. January to February, here it is, January to February will be 1 month later. So 1 month later is 45%. So 45% always back on your 80,000. So 45% here will be 36,000. Right, now the only reason why I started with January is because I wanted to revise this, and because we're dealing with January and February. You could start anywhere. Right, let's look at our February. We sold 120,000 on credit. We obviously cannot get any money in January. We're not going to get money before we sold. But again, so the 120,000 there, 40% of those people will be paying, which will give me 48,000. Then a second tier times 95%, and that means I will be getting in 45,600. Right. And then thereafter, the rest of it would come in, but we're not working beyond February. So let's go back to November. Now November, 1 month later would be December. 2 months later will be January. So coming in January will be 2 months later. And if I look here, the second month will be 10%. And it's always back on your credit sales. So 10%, 32,000, and thereafter the count is finished. In December, 1 month later, first of all, there's December, 1 month later will be 45%, so that's 72,000. And then 10% thereafter, 16,000. And then obviously we'll just total this up. So in the month of January, I'm expecting to get this 134,400. Some of it is money still from November, some December, and some January. Now this note is really just to assist you with workings, because there's a lot of figures here, and it's going to be very complicated if you try and put it all into brackets. So that's why this is there to assist you to be a bit more organized. Those figures then will go back into your cash budget as your cash from debtors. Just a last thing. They did say to you the balance will be written off in the third month. Now if you actually add up this here, this 85, that only comes to 95% of the account. The balance, there is another 5%. And past trends show that about 5% will not be received. Now that's a bad debt. You're not receiving the money, so it will not be shown in the cash budget.